Hey there, everyone. My name is Ryan Schul. Welcome to my analytics channel here. So, in the narrative today, I want to talk about dynamic correlation analysis for a network of ETFs. So, an ETF is exchange traded fund. We're going to network these together to see what the relationships are, okay? And just try to determine, are there stronger relationships between maybe something like a commodity ETF or an equity ETF or a bond ETF, or maybe just gold or oil or something like that, some type of commodity, right? So we're going to look at the correlations between these ETFs and base our analysis on that, and then try to pick the best group of clustered investments. So we can look at regime detection, clustering, right? Different types of commodities merging and splitting over time, and look at how clusters are going to change, or how the relationships between these clusters change. So we're going to focus on diversification and look at different types of movements and shifts between these different clusters. We're going to look at hedge effectiveness. We will visualize an actual network graph at the end of the analysis here, and then understand position sizing, risk of these different types of investments, early warning, contagion, things like this, storytelling for stakeholders, and any kind of linkages or, again, relationships between these different entities, which are different ETFs, right? So let's just jump into it right now. I have a starting date. I'm going to get everything back in time since 2020, 0101, so the beginning of 2020. This is pre-COVID. I think this is a good time to start the analysis. Before COVID, things were very different. During COVID, things got wildly different, right? So you can see a lot of changes at that time period. And now we're even in a different time period. This is, what's today? September 2nd, 2025. So that's about 5 3/4 years ago. So a lot has happened in that time span, right? We're going to capture all the movements and activities of these different ETFs. Okay, we have gold. You can see this is gold. This is the S&P 500. Again, this is the starting date. And I have a few other ETFs. You can pick whatever you want. Okay, this is really up to you. You can pick the starting date. It's going to go up into present day. We're going to get month end close. Okay, and the window time period that we're going to look for correlations will be 60 days. So again, these are different parameters that I think make sense in this type of analysis. If you want to do something else, by all means, you can do something else. You can do daily close. This, I think, will give you a lot of choppiness and a lot of noise. I think the month end is sufficient for the type of analysis we're doing here. But again, it's up to you. You can change these different parameters here and reset this to your liking, right? And modify that to suit your needs. So we're going to go ahead and pull in closing price right here from Yahoo Finance. We're going to use a Yahoo Finance endpoint, and we are going to append everything back in time for 5 years, 5 3/4 years, okay? So the next step here is to create the layout so we can understand the differences between these different clusters, and how these frames are going to fit together, and how they're going to interact and basically move together. So the clustering algorithm that I'm choosing is agglomerative clustering. There are a bunch of different clustering methods out there. Not tons and tons, but I bet there's probably 12 now. Let me see. Types of clusters in scikit-learn. Okay, so you can do a little research here on your own. Here's a few different types. I see K-means, affinity propagation, mean shift spectral. There's DB scan, optics. So some of these I don't think are really relevant. DB scan and optics I don't think are relevant. GMM might be relevant. You have to do a little research and see what makes sense for your needs. I went with this agglomerative clustering. I think that is going to perform very well. Another very popular clustering technique is K-means clustering. So that might work for you. Or some type of hierarchical clustering might work as well. Now, I didn't test those, but those three come to mind with this type of analysis, right? You can do some research on those and see which ones are going to be most appropriate for you. In number of clusters, I set that right here. That is going to be, and let's see, where is that defined here? And plus, okay, so it goes from here And oh yeah, so it's set to 4. So right now it's set to 4. If you think more makes sense, then by all means you can do more. I could reset this right now to 8 and run it, and we can see what kind of impact that has. Again, these are all parameters, right? So you can choose what you want, and everything is going to flow down into the model and be consumed by the model. And you can test different concepts or different ideas and see what the output is and see if that makes sense for you, right? I think in the last time I ran this, I had 4. If you think more clusters are better, then by all means test more. If you have a whole bunch of stocks, like hundreds of stocks over here, you will probably have a higher number of clusters. If you only have 1, 2, 3, 4, it was this like maybe 12, maybe 15. I think 8 might be too much. I'll go with 6. I did 4 last time. I'll rerun this and put 6 in there. So I think that's fine. Again, agglomerative clustering, we're going to look at centroids for the cluster, right? So the way this works is that we look for groups of different outputs, right? And if everything, not everything, but if everything for that group is homogeneous, based on the centroid, the central calculated distance between all those clusters, we're looking for the XY coordinates and the distances between those clusters. So the shorter, tighter groupings, shorter lines are going to have centroids right in the middle of those clusters, right? And that's what you want to look for, that tight grouping, to understand how these different ETFs are clustered together. If they're all over the place, you probably have too many clusters. If they're all dragged into one big cluster or 2 big clusters, it wouldn't be one, really. If you have 2 or 3, that's probably too few, right? So you might have to test this out a little bit and see what makes sense for you. And again, do some research on clustering. Some of these, I think dbScan will automatically pick the number of clusters. And I think affinity propagation automatically picks the number of clusters too, okay? So some of these will pick the ideal number of clusters automatically. Sometimes you have to tell them how many clusters, right? In this case, I'm picking 6. But there are techniques with the k-means. You have the silhouette method and the elbow curve that helps you determine the ideal number of clusters too. So you can do some research on that and see where you go with that. So I'm looking at different groups and different centroids. I'm creating a basic loop here. We're looking at the CX and CY coordinates, right? So I'm looping through this item right here, IDXS. If I do Control F, this is just a variable that's being set, and we're looking for all the inner variables within that. So if length equals 1, we're going to the local number of clusters, or if length equals 2, then we're going to a cluster array, and we're just going to treat that a little bit different, right? So an array is kind of like a string of different components, and if you just have one, then it's just one thing, right? So we get the community based on that, and then we have to find any kind of residual edge. So we did in this step over here. In step 2, we got the correlations, right? Step 3, we're focusing on the distances, right? So we're calculating all the centroids and all the distances between other centroids in different clusters and how those will move relative to all the elements or all the similar ETFs in those clusters. Now we're looking for the residual edges, right? So the edge is going to be the line between those nodes. The node is a little circle. The edge is a line that connects those circles. So we have to connect those so we know what the relationships looks like. So we're going to use a graphing tool for that. If you look closely, I already imported that over here. Network X is the graphing tool. I like this one a lot. I also use PyViz a lot, but I think in this case, I don't even need PyViz. PyViz is very nice for creating dynamic interactive nodes and edges between those nodes. But you have to use the right tool for the job. I don't think that's necessarily. I mean, you could use that, I suppose. It's probably overkill for this type of thing. So I'm going to stay away from that. So I'm looking for the edge traces, and this is going to help me plot everything. And ultimately, I have to get the correlations so I know how tightly correlated or how non-correlated all these ETFs are. So depending on the correlations, they're going to go into one of 6 different clusters, okay? So you have to look at the correlations. This is all driven by correlations. That's why the title is Dynamic Correlation Analysis for ETF. So I think I just ran that. I'll just rerun it just to make sure. And we were looking at 6 clusters. I see that. Okay. So I think the first part looks good. We can move on to cell number 2. Okay, now we can build the animation for our clustering. Okay, so this will take just a brief moment to run. Everything goes into this list right here. So anything with a square bracket or square, yeah, two square brackets, this is going to be a list. And if we do Control F, we can see we're pending all of the traces and then all of the dates. So these are the trading dates. Again, this is month end close for all the ETFs I picked. Everything is being appended into this plot frames over here, and that is going to be fed into our actual plot. Okay, so we're building this whole graphing mechanism, dumping everything into a plot, and then building the animation of that plot. So when we run this, we can see based on correlations how all these ETFs are moving together based on the cluster that they fall into. Okay, so I have this. Let me hit Control Enter to run it. And you can set the width and the height down here. So this is a dynamic interactive cluster. So I can hit play and we can see how this works. Okay, so here's one cluster over here. 2, 3, 4, 5, and 6, right? Oh, actually, these two are clustered together. So this is cluster 1 on the right. You have a big cluster in the top. That's 2. 3 is off by itself. 4, 5 is down here, and 6 is here. So GLD is gold. That is usually going to perform different from all these ETFs. Gold is usually different. Sometimes during inflationary periods, it's up a lot. Sometimes it's not up a lot. It's not really a good hedge against inflation. If the market is tanking, usually gold is a good place to go. Okay, so people run for cover. They seek shelter in gold. Between TLT and LQD, I don't know what these are offhand. I'd have to look this up. Finance. TLT and LQT. LQT. LT, I think that was it. Okay, so these two are going to be clustered together. Let's see if they're somewhat similar. And Yahoo Finance doesn't give me anything. Okay, let's try it again. Oops. So these are iShares Treasury bonds. Okay, so a bond is not going to move like gold or oil. So I'm guessing this other one is a bond too, LQD. Let me see, LQD. Put a comment here. Some kind of bond or note or muni or fixed income. So LTD, LQD, I mean. Is slow. I don't know if it's Yahoo or if it's my computer. It's probably not Yahoo. Okay, so another corporate bond. So that makes sense to me. That's why these two are clustered together. So what else do we have? XLE, I think that is oil. Let me go back here. XLE and oil are certainly going to be different. Yeah, this is energy. So that's why that's off by itself. XLU is what? XLU. Energy. Okay, so that's kind of interesting because we have two energy stocks that are in two different. Oh wait. Yeah, utilities. Utilities and energy could be clustered together. In this case, it's actually not. So these are two different clusters. All these others are together, right? We can zoom in and see what these are. QQQ, that's like a S&P 500 kind of thing. This is S&P 500, IWM, XLF. What's this? IWM, XLF. Okay, another index. Right, let's see what XLF is. Another index, I'm guessing. Yeah, Spider Sector Fund. Okay, so that's why these are all going to the same cluster. And then we have XLV and XLP. Healthcare, okay. So it's healthcare. Consumer staples. Okay, so actually consumer staples and healthcare are clustered together. These are all basically indices. This is energy. This is energy. And these down here are, what do we say those things were? LQD. I already forgot. LQD. Some of these I've never even seen before. Oh yeah, these are the bonds, right? So that makes sense to me. The bonds and the golds get clustered together. All the equity ETFs are clustered together, and we have healthcare over here. So if we increase the number of clusters, we'll get more dispersion, right? But at a certain point, it's probably going to be too too choppy or too dispersed. Like you need some of these clusters to be pretty tight. If you have two energy clusters that are very far apart from each other, this is probably um, not just a not good practice for doing clustering. So this looks like these two are still together. One, two. This is three, four. This is 4, 5, 6, 7, 8. I think this is off by itself, and this is going to be gold. This is going to be 10. So based on what I'm seeing, I think 4 is a good number of clusters to use here. So let's rerun it with 4, and I think we'll get something that makes a ton of sense here. Okay, and refresh this, Control Enter. So the 4 clusters should be very apparent. Okay, I think this is fine. We have 1 cluster here. 2, gold is pretty much always going to be by itself. This is going to be cluster 3. And this actually 1, 2, 3, and 4 is over here. And we can see all the lines moving. So this definitely works. I think it is a little bit hard to sort of understand all the details here. So in the last script over here, I added more features and more details so we can get just more information about these relationships. You can see the nodes over here. We have the name, the edges are represented by the red lines. But when I look at it, it's a little bit hard to decipher like what's really going on. I think I would actually switch back to either 6 or maybe try 5 as the number of clusters. Let me try that because 4 was have scattered around. It was a little bit too confusing. I actually think the 6 might have been better. Let me try 5. If that doesn't work, I'll switch over to 6. You just want something that's intuitive and just jumps off the page, and it's very, very easy to read. So I think even this isn't too much, right? It's still a little bit confusing what's going on. Let me go back and change this to 6 and rerun it, and then refresh the next cell as well. Control Enter. Okay, and we are at 6 clusters now. So these two are together. Gold is off by itself. That's 2, 3, 4. And again, it's still kind of hard to see like the true relationships here. So I'm going to have to add in more detail and just introduce more granularity into this kind of chart. So I can tell it's doing clustering. I can tell it's creating all the nodes and all the edges, which are the red lines. And the change over time shows how the edges are changing and those relationships are changing. But you really want to see like separate and distinct clusters, and I'm just not getting that over here. So I think we have to change our methodology just a little bit and at least introduce more information so it becomes more apparent what's actually going on. I have one more idea. I can go down to 3 clusters. This might get the bonds and the bonds together, the equities. I'm not sure what's going to happen with energy, but gold is probably still going to be by itself. Let's see. Now we have 3 clusters. So I think this is 1, these 2 in purple. I think this is going to be 2. Yeah, it's still a little hard to figure this out. So still not happy with the number of clusters. How many stocks do we have? 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Let me try this. I think it's only going to get worse if we add in 10 clusters, but I can test it and see. Let me know for sure. Yeah, it still doesn't jump off the page. So that is going to be 1, 2. This is 3, 4, 5, 6, 7, 8. It's told at 10. So maybe these are 2 separate clusters. My point is you can't really tell because it's just not enough information introduced. So I'm going to go back to 4, refresh it. I'm going to save this. Okay, I'm going to share all this code with you guys so you have everything that I'm having right now. You can download it and play around with it. So I'll save it with 4. Gold is going to be by itself. This is 2. I think this is 3. These two over here, and this is 4. So I think everything in gray is going to be 1, even though they're spread around. We can't see the 3-dimensionality here. So this could be like a case where you have some clusters in front of others that are very close. This isn't necessarily just horizontal and vertical. So this could be clusters sitting very close to each other on top or on the bottom, but we can't get this from this kind of view over here, right? So we really have to add in more information so it becomes very apparent which ETFs are going to which clusters, and we can actually make like a real determination here about how to do the analysis and really understand the potential investment risk here, okay? So we're going to add in more information, get absolute numbers. We can't have negatives here. You can't graph a negative in this kind of scenario. So we're getting absolutes over here. We're going to add traces and label traces. So if you look here, we have our first list, and we're going to do some appends to these lists. So I'm just looking for traces right now. I see traces and label traces. So label traces goes here. Okay, and everything is being appended onto label trace. You can see that that is the next list right here. I was looking for the first list, but these two names are kind of similar, so I'm not really seeing it. Oh, traces append. Okay, so it goes from here, down here, up into the first list, and then label traces goes underneath. I think that's fine. Yeah, I think that makes sense. Okay, I just had like a quick doubt there, but now I'm doubting my doubt. So I think we're fine. So we're gonna set up some basic text. This is HTML kind of coding right here, and we're looking for the strength of the relationships, right? The nodes are the little circles, and the edges are the straight lines between. And again, we want to get more granularity, so we want to extract more information. But first of all, feed more information into the graphing, into the network graph, and then extract that from the view so we can see really what these relationships are and how these different ETFs are related to each other. Okay, so let me hit the play button. Now you can see the movement over here. So this is pretty nice. We can see the degrees is greater than or equal to 75. This is the same. This is the same. This is the same. This is the same. So this is actually the same cluster over here. Strength is moving around. Okay, that's the sigma of the row right there, and the average row you can see at the bottom right there. So you can see the relationship. You can see the degrees and then the strength of the rows right there. And then, of course, all the clusters as well. Okay, so I think that's pretty much it. I have some notes down here. The red edges are positive. The blue are negative, and the thicker, the greater the row right here. So all these have kind of the same thickness. All the edges are red, right? You can see the relationships here. Whoops, I went in too far. And then, of course, you can see all of the nodes over here, right? And the relationships to all of the other nodes. So nodes are gray. Purple is bond. Gold is gold. And the labels can be toggled, right? So you can go over the label and all the information pops up. The animation for each frame is month end, right? So at the end of the month, we're going to switch to the new view and see the new relationships, which is pretty dynamic if you think about it, because in the stock market, if you just look at gold, we have relationships between XLI, LTQ, and then XLF. These are energy companies, right? But if I play this, these relationships are going to change over time. If you focus just on gold, sometimes you have one relationship, sometimes with just the equity indices at the top, sometimes with the commodities, and sometimes you have multiple relationships. I'm just looking at gold now just to isolate just one thing. So you can have 1, 2, or it looks like 3 relationships per month, and every month it's changing, right? So that's what makes investing in the stock market pretty tricky, because you can't just say, okay, I understand what happened last month or the last 3 months or the last 6 months, or pick some arbitrary time frame, last 60 days or last 90 days. that's fine. You can look at that. But is that really going to help you go forward to understand what are the best ETF opportunities and what are these relationships between these different ETFs? Because it's constantly changing. It's very, very dynamic. The correlations are always increasing and decreasing. The network paths are always changing, right? The path is the edge. This is the red line, and the node is the circle, right? And then the size of the circle represents the diameter, and that represents the average row over here. So you can see that this is 1.27, this is 1.1. I'm sorry, this represents the strength. I said it wrong. So this represents the strength. You can see the strength is decreasing as the diameter of the circle decreases, right? So XLU and gold are actually the same. They have a sigma of 1.0. This is the same 1.0. This is larger, 2.57. This is the biggest, 4.38. This is the S&P 500. And maybe just because it's more stocks and this is more followed and more tracked and probably used as a benchmark and a proxy, and more money will go into the S&P 500 than any of these other ETFs, just because this is just a favorite for investors, right? It's well understood. It's very diversified, or it used to be. I mean, now I think 7 or 8 stocks make up 25% of the value of the S&P 500. So it's not equally weighted. It's really market weighted, right? So it is diversified in the sense that it's 500 different stocks or close to it. It could be 499. It could be 501. It's not always exactly 500. But in terms of the weights of exposure to different investments, it's not diversified at all. You have about 7 or 8 different stocks that make up 25% of the S&P 500. Let me see if I can Google that really quick. S&P 500. Okay, this might do it. Okay. Okay, so that's what I'm talking about. So NVIDIA, 1, 2, 3, 4, 5, 6, 7. I'll go down to here. We'll get the top 8. Is that 8? 1, 2, 3, 4, 5, 6, 7, 8. And if you just do a quick sum, that's probably about 25% of the weight of the S&P 500. So, okay, that's great. We have 500 different stocks here. But if you go down to the end of the list, pretty soon you have 0.04, 0.04, 0.03, 0.02, 0.01, right? Whereas at the top, you have the big dominant players, NVIDIA, Microsoft, Apple, Amazon, Meta, Broadcom, and then Alphabet, which I think is Google. They changed the name to Alphabet. I'm not sure. I never understood that. I never understood why that happened. But anyways, I think Alphabet is Google. Yeah, they have that symbol over here, GOOGL. Maybe for, I don't know why. I don't even know why they did that. Different compliance reasons? I don't know why they changed it. I have to Google that. I don't really know that. But anyways, the point is about 8 companies make up 25% of the weight of the S&P 500. So I have some more notes over here. I'm not going to read this to you. You can read it by yourself. I will share all this code with you, so you have everything. You can copy and paste it and run it yourself. The last thing I'll finish up with here is that asset co-movements tighten or fragment in different market regimes. Shocks often propagate along the strongest edge. An ETF or sector can quickly become very volatile, and the highness or betweenness is now systemic, right? So if you have systemic risk, the whole market or a big chunk of the market is going to move in one way systemically, right? If you have very diversified risk, then different parts of the market are going to move differently. You're not going to have these big swings up and down, making money and losing money. But if it's systemic and the risk is systemic, then it's everywhere. You can't get away from it. You can't hide, okay? If the bond sleeve starts creeping into the equity cluster, the diversification benefit is not helping you too much, right? Like if you want a bond fund, you want to be invested in bonds. If you want an equity fund, you want to be in equities. If they start to converge, then no diversification is helping you at all. It's not very useful. So the last thing I'm going to end on is down here. We can look at the actual correlations. So we can go back in time. I set a window of 60 days. So from this date, we're going to go back in time. So 2025-08-01, this is August 1st, 2025. Today is September 2nd, 2025. If you look closely here, the window right here is 60. So we're going back in time 60 days. I think that's appropriate. You can make it 90 if you want. I think that's fine too. we're looking back in time 60 days to see what these correlations are. And this thing doesn't want to cooperate. I'm telling it to go down, but it's not doing it. Right, let me save it. It has a mind of its own. All right, let me save it and then just refresh it. And we can see what these correlations look like. Okay, so now it's working. Sometimes things just get jammed up. So basically, these numbers show pairwise Pearson correlation of daily returns over the 60-day window that we picked at the past. Remember, I had the 60-day n equals 60-day. So looking at these pairs, we can see different correlations. So gold and spider actually have a negative correlation. That's pretty much what I would expect. Spider is the S&P 500. Whatever that is going to do, gold is kind of going to do mostly the opposite. Not the exact opposite, but it's not going to be very correlated at all. QQQ and gold almost the same, 0.54. So the S&P 500 and the QQQ should be pretty similar. If I test that, we should have like a pretty high correlation over here. I'll add one more because I'm just seeing that right now. I think that would be a good test. QQQ, SPY. Yeah, 0.95. So these have a very high correlation. So basically this shows you all of the correlations over the last 60 days, ending here, going back in time. So we're going back to May 7th, 2025 and forward to August 1st. So the cutoff is right here. We go back in time 60 days, and this shows you all the correlations. So you can see gold is highly uncorrelated to these indices, right? So if these indices are crashing, and I would expect a market crash sometime soon, because I was looking at the market valuations for months now since March. Like, these things make no sense to me at all. Everything is so overvalued. And there's some major problems with the economy today, right? You have rampant homelessness, massive unemployment, about $38 trillion in national debt that the federal government is just barely paying on. And the stock market is at the highest that's ever been in the history of humankind. Like, this makes no sense whatsoever, guys. So I'd expect a big crash. These are highly correlated. If you do see the crash, I think gold and maybe oil would be a good place to go. Anything that has a negative correlation with SPY and QQQ, these are all not correlated. I think gold would probably be the best place to be. This isn't investment advice. This is just based on my historical observations. And again, like, I was watching a video yesterday and the guy was saying, well, these financial ratios don't make sense, but who cares? Throw them out the window. Like, nobody cares about financial ratios anymore. If we're really at that point, basically we're going back to 2001 with the dot-com boom, where nobody cared about valuation. And of course, what happened in March of 2001, massive correction. 2008 financial crisis, same thing. People just didn't care. They just throwing money into the market, all these subprime mortgages, nobody cares about it. What happened right after that? Major correction, right? The COVID crisis was very different. So you can't say that was overvaluation. That was like a completely different beast that had nothing to do with valuations whatsoever. But I think valuations are important. They've been important for well over 100 years. I don't know what the history of security valuation is. Maybe 150, maybe even closer to 200 years. At least for the last 100 years, people have focused on this very closely, except when you detach yourself from this, you set yourself up for major failures, just like we saw in 2001 and 2008. So my point is, if the market's blowing up, consider gold. Don't go to Spider, don't go to Triple Q, because that is going to be a recipe for disaster, okay? So I will save this. I will share this code with you guys. I will post that later when I drop the video on YouTube a little bit later today. I've got a couple errands to run, and it's getting late in the day, so I'll probably have to wrap this up and then take care of a couple little projects, and then try to get back to this stuff later today. So that's it, guys. I'm going to wrap it up. Thanks for your time today. Appreciate it. And I will see you in the next video, which I should post pretty soon. Thanks and goodbye.